Welcome to the Dealmakers podcast. The Dealmakers is a platform for leaders in the commercial real estate industry to share their personal stories, business insights, and industry secrets because we believe in spotlighting the real people behind the deals. This podcast is brought to you by Agora, a comprehensive real estate investment management platform offering a wide range of services to enable real growth and provide the best real estate investment experience both for GPs and LPs. I'm Asaf Raz. Let's go.
There's 3 publicly traded data center REITs that are out there, which means actually it's 2 publicly traded data center REITs these days. Well, 2.5. But investors and clients and advisors and institutional guys and sovereign wealth funds and everybody under the sun is earning dividend income by you and I having this conversation. And not only you and I, but how many other folks are on a Zoom call, a Teams call, a Riverside conversation right now across, let's just say America? Is it 10,000? Is it 100,000? I don't know the answer to that. I'm sure there's data that's out there that says how many calls are happening in a given minute. But the answer is there's a shit ton of people that are using this platform right now. And investors are just sitting back and collecting passive income by living their lives every single day. Here's another example. Do you have one of these things? Do you know what this is? This is a smartphone. There's 3 publicly traded REITs that earn revenue. Again, earn revenue every time we talk on a cell phone. Here's another example. I don't know if you'll be able to see it if I open it up on my phone, but do you know what this app is that I have open on my phone here? Did you know that if you order a package off of this app, you're using 3 different REIT sectors every time you press the Buy It Now button? You use 3 different REIT sectors to get that order to your doorstep. The takeaway that I want to impart in this conversation today, as I do in every single one of these conversations, we use all of these different REIT-owned properties and sectors every single day of our lives, regardless of what is going on in the world of interest rates, 10-year treasury, tariffs, Doge, whatever the headline du jour is, we are still using these properties. Example, you live in an apartment. Now, it looks like you're talking to me from Manhattan today. Manhattan's a little bit different than some of the other cities, but you're sitting in an office building. Is that office building owned by a REIT? Possibly. I don't know. Depends on where you're located. Is your apartment owned by a REIT? Possibly. Depends on where you're located. But you're still going to pay the rent at the end of the month when you renew your apartment lease every single month, right? So again, it's using going to Starbucks, going to the post office, doing a Zoom call, whatever it is. We're using these properties every day, not thinking about the big macro factors of, oh my gosh, the 10-year treasury is at 4.53%. I can't go get my cup of coffee at Starbucks today. Bullshit. That doesn't fly. That's not how we live our lives.
100%. So we're already diving into the conversation, and I love that. I'm going to do the opening really quick for the podcast, and we'll go into the questions. But this is a great opening to really who you are and how and what you're an expert in. So I'm going to do the opening really quick. Obviously, David, who started this conversation really deeply into REITs. Right now I have, how do I pronounce your last name again, David? Auerbach. So I'm here with David Auerbach. He's obviously a REIT industry expert. We also met at the Real Estate Gala a couple of weeks ago, which was amazing. But before I dive into all the specifics, Real Estate Gala, social media, and all that, David, please take us away. Tell us about yourself. What do you do today? Where do you work? What do you focus on? And we'll take the conversation from there.
First of all, to backtrack, thank you, Asaf. It's great to be here with you today. I've been looking forward to this for a while now. I've been in the REIT industry for 25 years in a variety of capacities. Institutional trading, sales, marketing, distribution, portfolio management, hybrid analyst, you name it, I've kind of done it. These days, I wear about 4 or 5 different hats across the REIT industry. I'm the chief investment officer of a firm called Hoya Capital. We are a REIT research and education platform that happens to also be an exchange-traded fund issuer. We have 2 ETFs listed on the New York Stock Exchange, the Hoya Housing 100 ETF, the ticker is HOMZ, HOMZ, and the High Dividend Yield ETF, the ticker of that is RIET. Between the 2 ETFs, we manage about $130 million. I'm the publisher of the daily REIT Beat newsletter. It's an industry-wide publication, goes out indirect and direct to probably 7 figures of folks every single day, sharing all the news headlines, ratings changes, press releases, performance metrics, news articles, all the things that are happening every single day in the world of REITs. You can learn more about that at the daily REIT Beat newsletter. I believe it's thedailyreitbeat.com is my website. I have it is the Daily REIT Beat. I also have a jobs website for the next generation of future leaders that want to get involved in the REIT industry, allthereitjobs.com. It's basically taking all the publicly traded REITs, scraping their career pages, and then highlighting the 10,000 potential opportunities that are open in our sector from coast to coast basis. And then lastly, I do consulting work on behalf of REITs, again, promoting that advisor education, telling these advisors and investors about these properties that they're in their backyards that we interact with every single day. At the core of this, my job is to network, market, and educate about the REIT sector, the real estate investment trust sector, because we are hit by these properties on our faces every single day, and we don't realize that we're interacting with these properties. I am not here to sell you something. I don't care if you buy my ETS, my newsletter, or any of that stuff. That is not my focus on this. My job in these conversations is to educate why you should be investing in this sector, why you should be looking at REITs in your portfolio for the next 50 years as a long-term holding towards your retirement. That's my purpose.
I love that. I love that. And David is very, very passionate. I do recommend that if you're interested in REITs and real estate in general, and anything in between, follow him on LinkedIn, follow him on Twitter. He just provides so much valuable information. And as David, as you said, you never sell anything, but you do provide so much value. Like I was blown away when I went through your pages. So thank you for doing that and helping the community.
Thank you so much. The check is in the mail.
100%. Okay, so let's talk about. We're gonna try to separate two things here. So we try to keep the conversations up to 15 to 20 minutes. Our audience loves it. It gives them a good understanding of who you are and what you're focused on. I think for the first part of this, we'll try to focus on the real estate itself, right? And you mentioned when we started the conversation, you mentioned tariffs and administration changes and, all that jazz around what's happening in real estate right now. And you showed me a bunch of examples. Like if you're ordering from Amazon, you're using a public REIT. If you're going on, and we're talking here, we're on Zoom or on Riverside, we're providing dividends back to public REITs that are in the data center space. Take us a little bit of how the current state of the market, the current situation in the market is actually affecting REITs and how they're kind of reacting to it, if there's any effect at all, or if it's just a lot of noise that we shouldn't really be listening to. Like, I'd love to get your opinion on that.
We could spend 30 minutes alone on that topic, because that is the topic du jour when it comes to the world of REITs right now. So let's kind of take it layer by layer by layer. The tariff level, the answer is we don't know yet. There is uncertainty. We don't know what the tariffs is going to be towards the REITs. But at the end of the day, at the actual REIT level, there really is no impact. What do I mean by that? You're a landlord. Your job is to lease out your property, to fill the space, the office building, the shopping center, whatever it is. Your job as the landlord is to lease the space. It's your underlying tenant that might be exposed to those tariffs, i.e., you're a Starbucks, cost of coffee goes up, you're going to pass that cost off to your consumer. But the cost to buy that coffee goes up, and so indirectly, you are exposed to that, and it may impact the landlord in that lease negotiation with that tenant down the road. But with a lot of these REITs, the contract, the lease terms are anywhere from, 3 years to 100 years if you have a ground lease on a property. So as a result, these companies kind of already know what the rent escalator looks like. They know that the rent's going to go up 3% next year, let's say. It's tied to the CPI or whatever it is. It's for a small tenant that is most essential to what's going on in the world of tariffs, that might impact your lease negotiation. But for a global conglomerate like Starbucks, they're going to be able, I think, to handle that type of stuff that happens. So that's issue number one. But then let's take it to the company level. I was in New York a couple of weeks ago before the gala, an event before the gala a couple of weeks prior, and I'm based in Dallas, Texas. So for all my stuff, I'm getting on a plane and traveling all over to go visit with these folks. Although I'm lucky that the big REIT conference comes to Dallas this December, so that's pretty cool. Anyway, so I'm in New York at NYU at this big REIT conference. There's 30 plus REIT CEOs that are doing these roundtables for this event for the NYU students, and it's the best one-day REIT event of the year. And obviously, tariffs and Doge were a very important part of that conversation. Well, before the event started, there's a breakfast, and I was chatting with some of these CEOs because I've known these guys for a long time, and they actually choose to talk to me, which is kind of cool. But I'm like, all right, hey, let's, address the elephant in the room, tariffs. They start laughing like, well, sure, it took you long enough to ask us that question. And here's how they phrased it. You have Liberation Day -1, Liberation Day +1. We'll use that time frame. And in talking to a couple of the executives, here's what they say. David, do you know what did not change over this 3 days? My earnings, how much I'm earning per share. Do you know what else didn't change over these 3 days? My dividend, how much I pay out to my shareholders every quarter, every month, or whatever it is. But do you know what has changed over these 3 days? Is my stock price. My stock price is down 30% on this news. What does that person know that I don't know who runs this company? Wouldn't you think that I would know the numbers and how this is going to impact us before that person who places that order knows anything? And again, the executive's not going to tell you, buy my stock, because of course, every single CEO wants you to buy that company's stock, right? Obviously. And what they're telling you is, our earnings haven't changed, our fundamentals haven't changed, our operations haven't changed, but my stock price is down 30%. Something has to give here. Indirectly, we think this is overblown, that this could be a buying opportunity. So I think from the company level, until we get more specific information, it's a bunch of who knows, it's a bunch of noise. And just like a lot of other cycles, these companies do what I call put the blinders on. They ignore all the noise and headlines and stuff that's being thrown at them, and they focus on the business. They focus on the operation. How do I grow my revenues? How do I cut my expenses? How do I grow my profits so I can pass more of that income through to my shareholders as necessary? And we've seen multiple examples of this. Forget tariffs. We've seen multiple examples of this through such events as long-term capital management in the late 90s, 9/11, the housing crisis of 08-09, the failure of Lehman Brothers, Bear Stearns, and the financial collapse of the markets, COVID. There's 5 examples right there of how management teams were presented with the problem. How do we address the issue so that when the next situation comes, we've learned from both our previous failures and successes to make sure that the game book was settled today for the obstacle at hand. Here's a perfect example. If you go back 20 years ago, my former shop called Green Street, which is one of the preeminent leaders of REIT research. Many, many years ago, Green Street came out and said to REITs, hey, you guys need to cut your debt levels. You guys have way too much debt. You need to go to a sub 50%, if not sub 25% leverage exposure on your balance sheet. And the response was, yes. Finger pointing. Are you out of your mind? Are you high? Are you crazy? That's not going to happen. That can't happen. Fast forward many years. REITs are 25 to some cases 50% levered. They learn from previous cycles, and they operate in the current environment. Why? Because they have seasoned management teams. It's not the flavor of the month running the company. It's the team that's been in place for 25 years, the junior executive that's worked his way up the ranks over 25 years, that gets the C-suite role, that's learned through these past 5, 6, 7 cycles, et cetera, learned from his leaders and mentors and people that helped him get to where they are today to navigate the roads for the next 25 years. That's the cool thing about this sector is we learn from mistakes, we learn from successes, and we figure out how to best operate in the current environment. So when people talk about the death of commercial real estate, the death of office, this wall of commercial real estate that's coming due, we see all the headlines on CNBC and Bloomberg and Wall Street Journal and pick your favorite publication. But you got to go to the company level, peel back the layers of the onion, look at the numbers and tell you. And when it comes to REITs, at least with publicly traded REITs, one of the benefits of this sector is called transparency. They publish press releases, earnings press releases, conference calls, investor presentations. They give you all the data. So they're not keeping information really that close to the vest. They're sharing this stuff out there with you so you understand this is where the puck is going. This is where the operations are going. Here's where the financials are going. Okay, I understand. Because at the end of the day, and I'll shut up after this, at the end of the day, the end investor, anybody listening to this call with the stocks that are in their portfolio, REITs, not REITs, I don't care. But here's what you should focus on. You as the investor want the company to do 4 things at the end of the day. Grow revenues, grow guidance, how much you're going to earn every single year, grow your dividend. You know what I mean? Like, again, grow earnings, grow revenues, grow profits, grow dividends. That's what you care about. And if they can do those various things, you don't care about all the other stuff that's being thrown at you, because the safest dividend is the one that just got raised. And by and large, many of these REITs have been raising their dividends over the past several months.
So first of all, I love this approach because again, most of the headlines talk about something, but then we look at the market and there's something completely different happening, or at least somewhat different. My question to you is, while let's say private syndicators, fund managers who just run, they raise capital from private LPs, put it into properties, pay back distributions every quarter, let's say, right? They have not been immediately, at least, affected as stockholders, right? Because stockholders, when tariffs went up, there was a lot of fear in the market. There's an immediate reaction in the market to this change, right? Or administration change, whatever change is happening. They immediately react to it. REITs are more exposed to these type of emotional reactions when it comes to stockholders. Did that affect REITs in any way? The fact that they are exposed to an emotional reaction of the end investor, right? It's not like a closed-end private fund that's running, let's say office or multi, that can talk to their investors and say, hey, this is what we're going to do to mediate the situation, or this is how we're going to handle the current state of the market. So how did they get affected by this, and what are some strategies they had to put in effect, which other regular funds didn't need to do?
So that's a phenomenal question. And you actually kind of teed it up perfectly, because, again, it goes back to this messaging and communication. Use COVID as the example, all right? A perfect sector to look at during COVID was gaming, casinos. The gaming industry shut down. Las Vegas shut down basically during COVID, right? The top performing REIT during COVID was a gaming REIT. It really isn't these days, but it's still considered a gaming REIT. It was called Vici Properties, VICI. Why do I mention that? Because all of Vici's tenants, MGM, etc., were paying the rent during COVID, even though the business was closed. Why? COVID's an event. We're going to come back. We're going to come back even stronger. Trust us. And so what happened? They came back in droves, and it's business as usual many years later. What I'm getting at, we kick around this expression called generational wealth opportunities. And buying REITs during COVID is a good example of a potential generational wealth creation opportunity. Because from a very high level, before COVID started, REITs were basically at an all-time high in terms of performance, both at the stock price and at the company level. They were firing in all cylinders, kicking butt and taking names. Then COVID hits. The S hits the fan, and it's a reset period, right? So now here we are several years later post-COVID. And what's happened is, if this was the peak in 1920 going into COVID of what the REITs were doing, we are here today as far as what these companies are doing for earnings and performance and all that stuff. But the stock prices are still at this level. The dividends still haven't caught up to where they should be. So the businesses as themselves are firing on all cylinders, business as usual, but the stock prices don't necessarily reflect that. As another example, A lot of companies, publicly traded companies, may have a preferred stock as well. A $25 par preferred is an example, meaning if it's taken out, you're going to get $25 a share plus accrued dividends in a perfect world. I mean, for some of those $25 par stocks during COVID, they sold off to like $8, $10, $12 a share, 50, 60% of their worth potentially. And for the investor that's like, oh my gosh, this is a huge opportunity. This is going to come roaring back. I can buy this shopping center REITs preferred at $12 a share. And then a year later, it's back at 24 and change, 25 and change. Like, I don't want to say free money, but that's about as close to free money as it gets out there. So, I think if anything, it goes back to that learning from previous cycles, that for a lot of these companies, they just focus on operations. How do I grow my revenues, cut my expenses, grow my profits, pay out more to my shareholders? But because the dividends haven't caught up, one of the things that a lot of companies have decided to do was, do I want to pay out this extra penny, 2 pennies a share to my shareholders, or should I keep that money internally to use it for a rainy day when the right opportunity comes along and it's a deal that's too good to pass up? And we're glad we had that capital because we can then go out and deploy as necessary. As I like to say about these management teams, they know when to go on offense, they know when to go on defense, they know when to turn left, they know when to turn right. And again, it's all through these previous lessons in the past to kind of figure out how do we operate in the current environment. We don't know where we're going to be tomorrow, next week, next month, next year. But the landlord will tell you, here's where we're going to be. And by the way, as far as tariffs, really there's only kind of 2 sectors that have addressed it right now for different reasons. The resi guys, the multifamily players, the single family rental players, the developers might be seeing it on the timber lumber side of the equation, okay? So yes, that's going to impact costs. The travel side, the hotel guys are seeing a slowdown somewhat from a different perspective. And it's not necessarily because of tariffs, but it's because of the impact of the tariff across other countries. As in, we put tariffs on Canada, the Canadian traveler doesn't want to come to the U.S., as I don't want to say on a spite, but because of the taxes and stuff. And so as a result, they decide to go in a different direction. Doge, the Doge example, is impacting the lodging sector more than tariffs are, because again, government agencies, conferences, group travel, that business segment has been impacted because again, Doge is forcing some of these conference events to be canceled. We're not going out to Southern California in the winter to host this event. We're going virtual instead. It's off the books. So there is a little bit of a trickle-down effect here, but at the end of the day, we're still going to the shopping centers and buying our groceries. We're still going to Starbucks and getting that cup of coffee. We're still going to the gas station and filling up the car with gas, etc. We're still using these properties hand over fist every single day, regardless of what's happening with tariffs and Doge and all these other things in the economy.
It goes back to all of my conversations. REIT or no REIT, publicly or privately held, it's all in the fundamentals, right? Properties are still running, people are still buying, people need a place to live, people pay their rents. So it's always this question of, kind of trying to stable between what we're hearing, where the market's going, trying to be this oracle that none of us really can, versus people actually still needing a place to do their stuff, to run their businesses.
You hit on a good point. I want to highlight 2 office REITs that are in your backyard as a perfect example. You're not very far away from the Empire State Building, the most famous office building in the world. COVID, no COVID, pick your favorite economic sector. Is the Empire State Building going out of business anytime soon? Are they going to be closing up shop anytime soon? Of course not. It's a destination mecca. It's a tourist mecca. The observatory, I think, represents 1/3 of the company earnings. So that tells you how much prominence that property has in the world of real estate. My other favorite example is an office REIT in your backyard called SL Green. They own a property called One Vanderbilt, among other things. It's one of the newest office properties in New York. Why do I mention One Vanderbilt? We'll go back to COVID. And when you talk about COVID, we weren't working in office buildings. The office guys were getting the absolute you-know-what beat out of them because, again, nobody was going to the office building. But do you know what SL Green was doing? They were leasing space. They were leasing boatloads of space during COVID. to the tune that One Vanderbilt basically got to 90% occupied during COVID without anybody showing up to work. Why? Because they were looking through it to the other side of how this is going to play out. We're going to come through this. We're going to have the single best asset in New York City, and people are going to want to come to work in this building. And they were getting laughed at for years. Dude, it's COVID. The office is dead. What are you talking about? Really? We're 92% occupied right now during COVID or whatever the number was. Who's the right person here? Okay, fast forward. It's basically 100% occupied. It is the mecca now of Grand Central and all that area that's going on over there, right? And so, who knows more? That shareholder making the bet, the retail investor that's taking a flyer, the day trader, the institutional guy, et cetera, or is it the management team that's working with the tenants and the operators and, their customers, and they know where the puck is going, right? So I think that's why you got to really peel back the layers of the onion and get to the real fundamental level. One more point. Remember that REITs are only a tiny blip in the whole world of commercial real estate. REITs are just one tiny lane of that highway that makes up the world of commercial real estate. And so just because we see all these headlines in the world of commercial real estate, you need to go to the sector by sector, subsector level, because how home builders operate is much different than how a data center operates. But we're all the same world together in commercial real estate.
100%. 100%. Okay. So I do have an obligation to the audience to stay at a 15 to 20 minutes. So we're going to edit a little bit out, but I don't want to say this. First of all, David shares all this information literally on a daily basis on all social media platforms and on the website. I love reading it. I love going through it. So I'm just super happy that we had this conversation. We get a sneak peek to how you work, how you think. Now, at the end of every episode, we do something called the Shameless Plug. Okay, that's where you shamelessly plug in anything. So this is the moment to sell, David. Okay, I know you're not used to it, but this is the moment you actually sell, right? You don't need to provide any value. This is where you shamelessly plug anything that you're doing today, anything that you want people to be exposed to, any partnerships that you're looking for. That's the moment to just spray it out, say everything that you think that you need. And hopefully sometimes the community comes through and they do good things behind the scenes. So that's your time.
So I do publish a daily REIT Beat newsletter, the dailyreitbeat.com. I'm Chief Investment Officer at Hoya Capital, hoyacapital.com. Our ETFs can be found on hoyaetfs.com, Hoya ETFs. My jobs website, allthereitjobs.com. By the way, all this stuff is free. It's not like I'm necessarily selling this stuff to you, but this is a way for you to understand more of the things that I do when it comes to the world of REITs. I'm great at off-market deals, connecting guys that have portfolios with potential REITs that are interested in transacting. I'm actually working on a couple of deals right now because of another podcast that I did that people reached out to me based off of this. I'm a networker extraordinaire. My job is to connect good people with other good people and make magic happen. If you're looking to work with REITs, if you're looking for introductions, I'm the guy.
I love it, David. I love it so much. So first of all, thank you so much for joining me today and sharing your valuable insights and experience around REITs. It's just enlightening. And every time I read your content or hear you speaking, it just makes me excited about REITs and wanting to put my money in REITs. So I'm going to look into that right after. To our listeners, thank you for tuning into this episode of the Deal Makers Podcast. If you enjoyed this episode, be sure to subscribe so you never miss out on the latest conversations with industry leaders. Stay tuned for more exciting episodes as we continue to explore the stories behind the deals and the people making them happen. David, thank you so much for joining me today.
Thanks, Asaf. I really appreciate it.